Are you aiming to build your career around investment banking? Then listen up, because of knowing how the bonds are working, it's not just nice to have, it's a must. Corporate and government bonds are backbone of the countless financial strategies, and understanding their difference can give you easily the competitive edge that you need. Those bonds play a crucial role in the way how capital moves through the markets, funding projects, stabilizing the economies, and generating returns for investors. And understanding their difference can give you easily the competitive edge that you need. But which bonds to choose and when, and this is exactly what separates informed analysts from the rest. Today we are going to explore those two type bonds in depth. We will break down their structure, why they are issued, and also we will try to analyze and understand what you can earn each year if you decide to invest in corporate either government bonds. A bond is essentially a loan that you, the investor, give to an issuer like corporation or government. And in return, issuer promise you to pay the interest known as the coupon payment at the regular intervals and repay the principal, or also we call it the face value, at the maturity. So let's break this down. So what is coupon? Coupon is the interest payment that is expressed as the regular payment annually from the face of the value. Then we have face value. It's actually the principal value of the bond. For example, most of the cases, it's £1,000. Maturity date is the date when bond's principal is repaid. And yield to maturity is the total return expected if the bond held to its maturity. Let's break it down a simple structure of the bond. Suppose you buy a bond with the 1,000 of the face value, a 5% as the coupon payment and 10 years of its maturity. This means you will receive £50 every year, which is 5% of that £1,000 that you initially invested, and the interest payments every year from now for another 10 years. And at the end of 10th year, you will get your principal of £1,000 paid back, including the interest paying that you were receiving for the last 10 years. Let's look now in the details of the corporate bonds. Let's look now in the details of the corporate bonds. Corporate bonds are issued by the companies in order to raise the capital which will help them to expand their business, finance some specific projects, or maybe refinancing the existing debt. Those bonds usually offer the higher interest payments compared to the government bonds because of they involve also the higher risk in investment. Imagine you purchase a corporate bond issued by X company with the following details: face value 1,000, coupon rate 6%, and maturity 5 years. So every year you will receive $60, which is 6% of 1,000 as an interest, and over the 5-year term your total interest earnings would be $300, which is $60 multiplied by those 5 years, and at the end of the 5 years you will also get your $1,000 principal back. There are a few reasons why companies are issuing the bonds. The first one is the raise capital for their expansion. So instead of raising more shares and diluting their ownership, so they decide to issue the bonds in order to raise more funds. Then other reason can be debt refinancing. Companies with the high interest loans may decide to issue the bonds at a lower interest rate in order to reduce their debt cost. But of course there is always risk, like credit risk. For example, if the company goes bankrupt or face some financial problems, you would lose part or even all of your investment. For example, during economic downturns, even established companies can face with challenges to repay the coupon payment to their investors. Let's look now at the government bonds. Government bonds are issued by national or local governments in order to fund the public projects. They are known for their safety and considered usually at very low risk of the investment. Let's you buy US Treasury bond with the following details: The principal of the bond will be $1,000, the interest paid annually will be 3%, and the maturity of this bond will be 10 years. So you will receive 30 years every year, which is 3% of that 1,000 principal that you pay in the beginning of your investment. So at the end of the year, you will make $300 in the coupon payments, which has been paid to you by the issuer of the bonds, so by government. And at the end of 10 years, you will also get $1,000 of the principal that you pay. So the main reason why governments issue the bond is infrastructure and development. Bonds help finance roads, schools, bridges, libraries, and other public works. So the main reason why governments, and as I mentioned already, there is very low risk of the investment in the government bonds. For example, US Treasury bonds, they are considering virtually risk-free. And another reason is predictable income, because of fixed coupon payment make government bonds very attractive options for the income-focused investors. For example, when we look in the details of the risk of the government bonds, we can see a lower yields because of the trade-off for the safety is a lower yield compared to the corporate bonds. Then we have also inflation risk, because of when inflation risk rise above the bond interest rate, the real return can be negative. So when we look at the risk level of those two types of the bonds, then we can say that corporate bonds, they carry more credit risk level compared to government bonds. They are much safer. Yields. So the government bonds, they offer higher risk due to the higher risk, while the government bonds, they will offer you lower risk and more safety. So as the investor, and you're choosing to invest in the corporate bonds, which is ideal for the investors which are comfortable to moderate the risk and they are looking for the higher income. And maybe if you are in your 30s or 40s and you can tolerate the market fluctuations, then corporate bonds yielding from 5 to 7% can be amazing addition to your portfolio. Then when we look to the government bonds, that is in it, it's more suitable for the people who, I would say, more conservative type and maybe close to retirement. And even by the official statistic, it was shown that people who are retired or closely to their retirement, they choose more US Treasury bonds as the investment because of the lower risk and stable income. So understanding the difference between corporate and government bonds, it's a very crucial in investment decision, and particularly if you are building your career in investment banking. If you enjoyed this video, you might also like this one, and please don't forget to subscribe if you haven't yet. And thank you very much for watching me, and see you in the next video.